May the 4th be with you, and may we all be incentivized by fantastic gains to continue pursuing our dreams. We had an incredibly volatile week. Monday, very volatile. Tuesday, very volatile. Today, obviously, incredibly volatile. And we had a pretty dramatic downside on Friday. We were down some 4% in the NASDAQ. So we had that aggressive drop. And then we had 2 days, 2 green days. Monday and Tuesday were both green on all 3 major indices. That signaled to me, the panic sellers were selling on Friday. And they didn't want to be holding the bag going into the Fed meeting. They didn't want to be the last one out. They were fearful that there were others like them, and they thought they were getting in ahead by doing their selling early. So Friday was really that sort of capitulation in our mind. Monday, Tuesday, we saw, these are signs sellers are exhausted. Today we did see some selling, but we bought the dip very, very aggressively. We loaded up on ARKK calls expiring this Friday. We loaded up on Jumia calls expiring this Friday. We went in. We went in. We discussed on Monday how we would start, or Friday maybe. We were using margin for our first time in history in a meaningful way, intentionally using margin, not just, buying a stock while we wait for a seller to execute when we're all in, essentially. We had, 5% margin. We kept it. This is not a short-term, rounding error type of thing. We are levering up 5%. We felt confident going into this. And I felt particularly confident as the market was crashing this morning. Because, like I said, Friday was the capitulation. And that increased in confidence when Monday was up, and increased dramatically in confidence when Tuesday was up. And there was a lot of volatility on those days. The market was both up and down multiple times on both of those days. So the sellers did not have enough power in them to take the market down. They just simply didn't. I'm not saying that there was, aggressive buying, but there were some bottom fishers there, and we were bottom fishers, and we are being rewarded heavily with our best ever day as a fund, at least in terms of total AUM increase via capital gains. We had about almost a 7% day today. I'm very happy with that. We'll take it. I'm sure my clients are very happy with that, although they don't often text me when we're doing well, only when we're doing poorly. That's okay. We are here for the tough times, as you all know, because we make these videos every day. We record our performance every week publicly on the Twitter. Love to find another fund that does that. At least doing this type of thing we're doing. We're not here to talk, badly on anyone or over exuberate our success. Let's get into the Fed and why the market rallied today. Most importantly, taking 75 basis points off the table. If you watched yesterday's video, we discussed how a firm like JP Morgan said yesterday that there was a 1/5 chance that the Fed was going to hike 75 basis points. Part of our logic for expecting a rally today was that notion was held by JP Morgan, a very large participant in markets, and we assumed, based on the rhetoric we've been hearing and the positioning and how the market was reacting and moving, that sentiment was shared and was somewhat consensus. So if 75 basis points was consensus, we had to decide, are we going to get 75 basis points or not? Or at least a chance of 75 basis points was baked into the cake and shared amongst market participants. We thought that 75 basis points was unlikely, given that Bullard having said that the bond market was pricing in the Fed's movements, and Jerome Powell saying we were in an era of low interest rates for years to come. Both of these quotes are this year. Bullard was 2 weeks ago. Powell was in January of this year. A long time ago, but not that long time ago. So our assumption was 50 basis points. If we get a 50 basis point hike, that means we're not getting a 75 basis point hike, which means the market has to adjust for lowering that probability, and that was going to be dovish. So we viewed the odds as in our favor for a dovish outcome. And I'm not saying this is dovish, we're quantitative easing, but it's not uber hawkish. I think it's very mature, very calibrated, very responsible. And I think, last year I was talking about how I thought inflation was going to be a thing. And inflation was a thing. And I was getting, some hate for that, particularly from institutional investors, these types. A lot of people thought inflation was going to be transitory. Everyone was saying, oh, lumber, used car prices, it's all going to turn around. Well, it's obviously broadened out, and obviously unforeseen events have had an effect on that. Russia-Ukraine war, did not see that happening last year, but it's happening now. Certainly having an effect on inflation. So, not trying to, say anything about anyone. But, we are now not going to be getting tremendous tightening. We're going to get 50 basis point, 50 basis point, 50 basis point possibly, or 25 basis point from here. Instead of 50 basis point, 50 basis point, 75 basis point, or 25 basis point last time, 50 basis point today, and 75 basis point next time. So we actually probably got, of what all the, reasonable, the stuff in, whatever it is, in like the middle, most probabilistic, yada yada, standard deviation, we got all of the way at the dovish end within the reasonable standard deviations. The Fed did not, I'm not going to say they were super dovish, they didn't veer outside the typical standard deviations. They stayed within the standard deviations, but they gave us a well-calculated approach, and the market was incredibly sold. Everyone was so bearish. We talked about this in the last two videos, how, this milking conference going on that they're televising on CNBC, like everyone except Howard Marks is just so bearish. And we talked about in previous videos why this phenomenon is, why it makes sense. A lot of Reddit people want to poo-poo institutional investors. We're not doing that. These are very smart people. I'm sure we would all love to manage $1 billion and get a 2 and 20 fee. Okay, we'd be very rich. Clearly, that role is reserved for very intelligent people who are very sharp and very smart and deserve to be in that role and have been selected for that role. These are smart people. But their consensus was very obvious. It was, a lot of them were thinking the same way. And when a lot of money, because they represent these institutional investors, it's not Roaring Kitty and his $1 million or however much. I'm not trying to say $1 million is a small amount of money, but it's not, 600 billion. Times several people, times, then you can scale down into the 10 billion, still a lot of money, obviously, compared to Roaring Kitty, who's fucking lit, but who's lit, but, it's just numbers. So when that sentiment is so bearish, and these people are afraid of losing money because they are controlling so much important money, they want to keep doing what they're doing, etc. You have to bet against that. If you're getting signs that it makes sense to bet against that. And we've laid down our logic for why we thought the market was going to rally today. We did that a little bit today. We did that in yesterday's video and the video before that. So we think we made a very well calculated decision, and we're seeing the results of that. Now where do we go from here? If you go to the videos before the last Fed meeting, we expected a rally as well, and we got a rally. But we didn't expect a rally to new all-time highs. And when the rally got pretty hot, we started getting worried. We were saying this isn't okay, and we started going short. I don't think we need to have a rally to new all-time highs. I would not want to see that. I don't want to see a rally like we saw last time. A day, 2 days, 3 days, maybe we close out the week very strong, up 5% from the lows. from, the flat line today. We can have another day like today. Maybe we split it up into two. After that, we better have a pretty flat market. If we have a strong rally and it's, all in everything, things are going to get rough. Why? Well, isn't the Fed going to be dovish now? Aren't they not hiking rates that much? Shouldn't we go all in on tech? The thing is not, in my opinion, is not only that the Fed is hiking rates, but if you go to the previous all-time highs, valuations were too expensive. Shopify, great company, great product. Only now, after a massive drawdown, is it buyable. Kind of buyable. And it's around 20 price to earnings. 20 price to earnings, 20 years is a lot of time to get your money back and just break even. We'll grant them a rate of growth, so maybe it's not 20 years, but still a long time. 20 PE. That's an acceptable multiple for a large company, which Shopify is. It's a large company. We can't go back to having these 60, 80 multiples on large companies. Obviously, there's more homework to be done. If they're investing a lot into the business, great. That is great. Businesses should do that. But they should also be profitable. And they should also be priced at reasonable valuations. And once you start getting beyond like 30, even, you're getting quite expensive in my opinion. So now I think things are, I'm not saying, there are some attractive buys, particularly in the 10x growth stocks because institutions just wanted to, whack-a-mole with that. And they did that a little too much, I think. Particularly because the genetic engineering companies, and I'm just going to make this, in my opinion, what is painfully obvious, but the genetic engineering companies have had massive progress and strides since COVID started. They have obviously been in the focus of that. Their stocks all hit all-time highs because of it. And they're trading below pre-pandemic levels when people gave less of a about genetics, healthcare, the future of healthcare, etc. Doesn't make sense, especially when the companies are improving and showing that their technology is very viable. And therefore, I think it's viable. And those companies, I think, are at good and or great valuations. Netflix, Shopify, Facebook, okay valuations, fair valuations. We can give them a little bit back, a little bit of a bump here, but then I hope those companies stay relatively flat, maybe a little up, maybe a little down, not necessarily make a beeline straight to new all-time highs. If we see like a 40% run in Shopify, I don't know what will scare me, but that number definitely will. That's too strong. That's too strong in my opinion. 20 PEs. We want to keep companies around 20 PEs. We don't want to get back into the 40, 50, 60, 70, 80. No. Nope. Unless they are doing something tremendous. I think those multiples are reserved for companies that are small or companies that have found a way to add massive markets like Tesla with robots. Think that's okay, fine. What am I going to do? Debate Tesla getting a multiple larger than all the car companies? It's clearly not just a car company. And, but I don't think Shopify is going to start making robots. I think they're going to do a very good job of what they do. They're going to try to acquire more customers. They're going to continue to improve the product. And they're going to grow their business. But do I think they're going to start making robots to replace all labor? No, I think that's reserved for Tesla and, maybe Boston Dynamics. Maybe Apple starts doing something in there. We'll see what happens. But that's a massive new space. I think Shopify entered a massive new space. And now they have to focus on delivering for their customers and generating profits and being a good business. And that includes improving their business. So we're going to assign growth to these companies. We can give them a growth multiple. Let's not get too ahead of ourselves. We saw what happened with that. I don't think it was just rates. I think it was also valuations. And rates really just forced us to think about that. So that's today's video. And until next time, peace out.